Yo, what's up everybody? It's your boy Money $3 back with another video, and today, we're talking about support and resistance, but not just the basic stuff. We're diving deep into the indicators that can really give you an edge in the market. Think of support and resistance like levels on a video game. Support is where prices tend to bounce back up from, kind of like a safety net, and resistance is where prices struggle to break through, like a ceiling. Knowing these levels is crucial if you want to make smart trading decisions. We're going to break down 4 powerful indicators: pivot points, Fibonacci retracement, Camarilla pivot points, and Gann levels. I'm talking about going from zero to hero on these indicators so you can start using them to identify those key price levels where the real action happens. Alright, let's kick things off with pivot points. These bad boys are calculated using the previous day's high, low, and closing prices. Don't worry, it sounds more complicated than it is. Think of it like this. You're taking a snapshot of the market's sentiment from the previous day and using it to project potential support and resistance levels for the current day. It's like having a crystal ball, but instead of a fortune teller, it's math. There are actually a few different pivot point levels. You've got your main pivot point, which acts as the central pivot. Then you've got your support levels, labeled S1, S2, and S3, and your resistance levels labeled R1, R2, and R3. The further away a support or resistance level is from the main pivot point, the stronger it is. So, if the price is struggling to break through R2, that's a much stronger signal than if it was struggling at R1. Now here's where the magic happens. Traders use these pivot point levels to make informed trading decisions. Let's say the price bounces off S1 and starts heading up. That's a bullish signal, and traders might consider buying in. On the flip side, if the price breaks through R1, that's a bearish signal, and traders might consider selling or shorting. It's all about reading the price action around these levels and making smart decisions based on the signals the market is giving you. But here's the thing. Pivot points aren't foolproof. No indicator is. They're just one tool in your trading arsenal. You've got to use them in conjunction with other indicators and your own analysis to get the full picture. Next up, we're talking about Fibonacci retracement, and no, this doesn't involve solving complex math equations. Fibonacci retracement is all about identifying potential support and resistance levels based on the Fibonacci sequence. You know, that sequence where each number is the sum of the 2 preceding ones? So how does this sequence apply to trading? Well, traders have discovered that markets tend to retrace a predictable portion of a previous move before continuing in the original direction. And guess what? These retracement levels often align with Fibonacci ratios. The most commonly used Fibonacci ratios are 23.6%, 38.2%, 50%, 61.8%, and 100%. You'll usually see these levels plotted on your charting platform. Now here's how you use them. Let's say the price of a stock has been in a downtrend, and it suddenly starts rallying upwards. You can use Fibonacci retracement to identify potential levels where the price might pull back before continuing its upward move. For example, the price might retrace to the 38.2% Fibonacci level before bouncing back up. Traders might see this as a buying opportunity, anticipating that the uptrend will resume. Fibonacci retracement can be used in conjunction with other indicators like pivot points to confirm potential support and resistance levels. It's like having a secret map that shows you where the market might be headed. Now, if you're a day trader, you're going to want to pay close attention to this next indicator, Camarilla Pivot Points. These bad boys are similar to standard pivot points, but they're specifically designed for short-term trading. We're talking about scalping profits within a single trading day. Camarilla pivot points use a different formula than standard pivot points, and they place a greater emphasis on the closing price of the previous day. This makes sense, right? Because in day trading, the most recent price action is often the most relevant. Just like with standard pivot points, Camarilla pivot points have various support and resistance levels, but they're labeled differently. L1, L2, L3, L4, and H1, H2, H3, H4. Day traders use these levels to identify potential entry and exit points for their trades. For example, if the price bounces off L3 and starts moving up, a day trader might enter a long position, aiming to exit at H3 or even H4. The key with Camarilla pivot points is to be quick on your feet. These levels are meant to be traded intraday, so you need to be ready to react to price movements as they happen. Last but not least, we have Gann Levels, a technique developed by the legendary trader W.D. Gann. Gann believed that time and price were interconnected, and that by understanding these relationships you could predict future price movements. Talk about next level. Gann levels are based on geometrical and mathematical principles, and they involve drawing lines on a chart at specific angles. These angles represent different price and time relationships. The most important angle is the 45-degree angle, also known as the 1-to-1 angle. Gann believed that when price and time were in balance, the market would trend along this 45-degree angle. If the price moved above the 45-degree angle, it was considered bullish, and if it moved below, it was considered bearish. Gann levels also include other angles such as 22.5 degrees, 67.5 degrees, and so on. Each angle represents a different price and time relationship and can be used to identify potential support and resistance levels. Now, Gann levels can get pretty complex, and there's a lot more to them than what I've covered here. But the main takeaway is that they offer a unique and potentially powerful way to analyze the markets. That's it for today's video on support and resistance indicators. We've covered a lot of ground, from the basics of pivot points to the complexities of Gann levels. Remember, these indicators are just tools, and it's up to you to learn how to use them effectively. The more you practice, the better you'll become at identifying those key support and resistance levels. If you found this information helpful, make sure to like, subscribe, and hit the notification bell for more trading tips and strategies. And don't forget to share this video with your fellow traders. Let's spread the knowledge and help each other succeed in the markets. Thanks for watching, and happy trading. I'll catch you in the next one.